How's it going, everybody? And thank you all for joining us today for our webinar. We do one of these every quarter. This quarter, we're talking about an introduction to multifamily. It really is from the ground up, how these syndications work for investors and how we are setting these up for our investors. And so let's jump right into it. I'm Hayden Dewar. My partners, Matt Urakami and Rory Lee, are joining me today, and this will be recorded, so you guys can go take a look at this anytime. We'll be putting this on our YouTube, and we'll send that out as well. All right. So, what is a multifamily syndication? And in a general description, it is a multifamily syndication is a partnership where investors pool their capital together to purchase large apartment buildings led by a sponsor or a general partner who manages the asset. And it allows passive investors or limited partners to own a share of these high value properties. And these limited partners all the benefits are passed through from the property to the limited partners. So they get all of the benefits for just being a passive investor. Now, the difference between GPs and LPs. General partners or GPs or sponsors, it's said in several different ways. They source the deal. They do everything. They do all of the, they dive into the research on the markets. They source the deals. They make all the relationships with the brokers, with the insurance companies, so on and so forth. They set up the whole deal, and then they raise the capital for the project. And they manage the deal once they close and then make all the decisions throughout the management of the deal. The limited partners, on the other hand, they are investing their capital. So they're strictly a passive investor in every sense of the word. They're reviewing reports. They are reviewing the updates on the property and making sure that their investment is in good hands. And other than that, they're not making any decisions on the property, but they share in a large portion of the equity. The profit sharing of the cash flow, equity, and tax benefits, like I said, all pass through to the limited investors. And as you can see on this pie chart below, a typical structure can be anywhere from an 80-20 split, so 80% to the limited partners, 20% to the general partners, to a 60-40 split. It really just depends on the structure of the deal and the returns that the deal is giving. Now, how a deal works, as I mentioned, we source the deal, we raise the capital for the project, and then we acquire it. From there, we improve all of us as general partners, make the improvements if it's a value add deal. So we go in, we optimize the operations and reduce expenses as much as we possibly can. We improve the income through forced appreciation or renovations. And then we run the project from A to Z, or from day one to the day we exit. We increase the income, which then increases the value of the property, and we'll go into that a little bit later, and then we exit. So that's ultimately, from a simple standpoint or high-level standpoint, how these projects work.
So I'm going to get into a bit of why multifamily syndications exist. From us and our standpoint, it is as general partners, it is a income-producing asset. And there's a myriad of ways to make money through syndications, which I'll touch on in a bit, 5 ways specifically. It is a logical investment strategy. The property itself is a business. It operates in its own right, meaning from the day you acquire it, you're going to increase your revenue. And to increase your revenue, it's a pretty simple strategy in the sense of you're going to renovate units, you're going to increase rents, optimize all the operations and expenses, and really at the end of the day, everyone needs a place to live. Outside of that, it is professionally managed locally And then on top of that, we are also very hands-on general sponsors or general partners that also make sure that the day-to-day operations are running efficiently.
Thanks, Matt. So multifamily fits a variety of type of investors. A lot of times it's busy professionals. Like myself, I first started investing in long-term rentals out of state. But unfortunately or fortunately, I learned that that process is not as simple as it looks. I had 13 different properties. That's 13 different roofs, maybe 13 to 30 different toilets and sinks, 13 different AC systems, and just a myriad of things that I had to manage. And as a busy professional, I didn't have the time, or I just soon realized that this process was just way too much for me to manage. And the multifamily strategy investment really simplifies everything under one roof. Although you do have, maybe 30 apartments in one building, typically the apartments are typically still, pretty uniform. So it simplifies everything. You have one roof, one sewer, one plumbing line, one electrical line. So it makes it much more simple for busy professionals to manage. And secondly, multifamily is a great diversification as from the stock market or equity. I was always taught way back when that never to invest and put all your eggs in one basket. So we're not asking anyone to, or anybody we wouldn't recommend that someone put all their money in the market or all their money in multifamily, but it's a great way to invest, diversify. One of the benefits that a lot of investors like is that these assets are backed by a real property, which makes it less volatile to ups and downs in the market. Again, multifamily are for people to invest passively, where once you choose your operator, you just let them do all the work. Your job obviously would be to keep an eye on it, and we give you updates regularly. But I think one of the biggest benefits is that typically for someone to invest in multifamily and purchasing multi-million-dollar properties, usually they would need millions of dollars to do this. What syndication allows you to do is it allows you to be a part of this type of investment with a really low barrier to entry. So it makes it accessible for regular people like you and me to be able to invest in multifamily and buy a 50 apartment unit building in which otherwise you wouldn't be able to do. And then there's also the tax benefits. So that's, I was again, it's not what you make, it's what you keep. So because you're investing in real estate, the IRS has allowed you to capture depreciation. So as an owner in the property, you have depreciation. You also share in all the expenses. So this tax benefit can be significant for a lot of investors.
Yeah.
Very well said. As mentioned earlier, there are 5 ways to make money through a syndication. There is monthly cash flow, the forced appreciation, meaning when the sponsors or the general partners are going to go in, renovate units, and increase rents, basically increasing your net operating income. There is the principal pay down as you pay the mortgage monthly. There's options to refinance 2-3 years down the line when the property is stabilized and rents have increased and you've increased the net operating income. There's a chance to refinance and pull out some capital back to investors. And then, as Rory was saying, the tax advantages through depreciation being the big driver there are the 5 ways that you can make money through a syndication. Now, the active general partners or the sponsors, So there's active investing and passive investing. The general partners being the active investors, and there's a few mentions here, a laundry list of day-to-day activities that they're going to do behind the scenes that limited partners aren't necessarily going to see every step of the way. But it starts with the acquisition, building those relationships, and being able to source deals, whether they're off market or on market. Once you find those deals, you have to underwrite them. Now, a lot of sponsors have predetermined markets that they've done all their research on and like, so they'll target those markets specifically and underwrite deals that they like in those markets. Now, once you find a deal you like, there's negotiating contracts, the entire due diligence process through escrow, raising the capital from limited partners, and then securing the loan. Once you have acquired the property, there is the day-to-day activities as far as asset management and project management from a renovation standpoint. Managing the renovations through a 1 year to 2 year period, making sure all the units get renovated and stay within budget. That's part of the job of a general partner. Regular calls with your property manager to make sure the property is performing the way you want it. So you're managing a manager, but it's being hands-on and making sure that the day-to-day operations are handled accordingly. Investor relations, that comes with financial reporting and accounting, making sure we are communicating effectively and continuously through the life of the investment to our investors. If there's any refinances on the property, and then handling the entire exit through a sale at the end of the business plan.
Yeah, we really wanted to show this graphic, or we wanted to show this slide. If you can go back for a second, Matt.
Mhm.
To share with you that you could absolutely do all these things, you as an investor yourself, but do you want to do it? Do you have time to do it? Are you a busy professional like Rory was mentioning earlier, where you don't really have the time to sit on these property management calls or find these deals or do all the research? We've already done that. And the sponsors in general, I mean, you hope, but most sponsors in general have already done all the background work and gotten these deals sent to them, and the best deals in the market sent to them. And so you trusting the active investors to go out and execute is the biggest factor. So we wanted to show you or outline everything that we do on the back end for our passive investors. But anyway, I'll let Rory take over for on the passive side.
Okay, so yeah, the other part of the equation is the passive investor, or what we call limited partners. So what would a limited partner's responsibility entail? So most importantly, you have to vet the sponsors. There are literally thousands of syndications out there, operators that are out there operating syndications. It's important that you trust the syndicator and then the operator, and do your research on them. A lot of times there's companies promising crazy returns. You double your money in a year or whatever it might be. And, usually if it sounds too good to be true, it probably is, or either that or there's a lot of risk. So vetting the sponsor is the most important thing. You need to feel comfortable with them and trust them and trust the process. Secondly, you have to understand the investment just on a high level and an in-depth level. If it's something that's too complicated for you to understand, before you put $1 of your hard-earned money into that, you really need to understand what the investment is and what the business strategy of the business. Like Matt said, it's a business, and we have a business plan, and you have to understand that plan and what our strategy is to achieve that through time. So understanding the investment is very, 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 very important. And then, I always say trust but verify. So trust what, once you trust your operator, you need to verify it and really realize, are the assumptions that we're making in that business plan or whoever it is that you decide to invest with, and this could be any business, that are they realistic things? Is that something that's reasonably achievable or highly probable that we can achieve? So that is very, very important. And also, obviously, do the market research. Look at the area that you're investing. Is it someplace that is and Matt and Hayden, I believe, will get into what markets we choose. But when it's important to realize when you're choosing your market, don't look at it from an area that would I live there. It would be, is this an investable market? And do your research based on that. Okay. Investing in multifamily comes with, numerous benefits. So obviously participating in the returns. So in the returns, obviously, again, there's, you participate in the cash flow you participate in the debt pay down of the loan. Now, I want to back up a second. As a limited partner, you are not signing on to any loan. That is the responsibility of the general partner. So you have no responsibility on the loan. It's just, but you do enjoy the benefits of paying down that loan as a limited partner. You also enjoy price appreciation, which hopefully that's something that happens, we're all in this business to hopefully have a property that's worth more down the line. And also, like I mentioned before, the tax benefits. So again, as a limited partner, there's no day-to-day involvement. You're there to monitor we will give you updates regularly. And it's your money, so we would want you to be abreast of what's going on. And that's it. The other real benefit of is a lot of like I mentioned before, a lot of these deals are, multi-million-dollar deals, that you're buying 30, 40, 50, 100 unit apartment buildings. As a normal investor, as a regular person, it's very hard to get into those type of deals. So as a participator in this project, you're able to get access to these larger deals.
Perfect. And I'll jump in. Kind of want to give a case study and share with you one of our projects that we closed on in June of this last year. So we're about 8 months in. I wanted to dive into what it really looks like. I'm a visual person, so this really helps me. So hope it helps. Now, this was a 33 unit project, and it was all studios, classic, really old, as you saw in the previous picture, 1980s build. We purchased it as a 33 unit, and we've been able to add the laundry room. That's part of the business plan as well. So adding more income, so figuring out ways to add more income. And this had a great opportunity. So like I said, we acquired this in June of this last year for $2.05 million. And we went into the project with the understanding that it was going to be a 4 to 6 year hold. So when we go into the projects and you're looking to invest, we will let you know, or we'll share with you what that hold period looks like, whether it's 3 to 5 years, 4 to 6, or beyond. If it's 7 to 10 years, we'll let you know early to see if that's something you have an appetite in. All right. So why we bought this particular deal, aside from the fact that it was in a great neighborhood in Kansas City, Missouri, all of the metrics on the right that you see on the right of the slide, that you see: rent growth, unemployment rate, population growth, median income, and vacancy rate. All of those metrics were headed in the right direction, or trended in the right direction. And so that's ultimately why we chose Kansas City in general. And then also this submarket, which is a great submarket to be in, just north of the city. So we look at not only the macroeconomics of the metro, but we get as granular as the neighborhood of the investment. So this neighborhood was a great neighborhood. We like to look at projects that back up to residential areas. This is right across the street from a residential neighborhood. And there's also really solid access to freeways right down the road. So One other major factor that I was ingrained into me since day one in investing was cash flow from day one. I'm a big advocate for cash flowing properties from a going in perspective. So when you buy the property, the property still makes money. And that also gave us a little bit of leeway when we went in to go in, a little bit of cushion, excuse me, when we went in to renovate these units. We could renovate a couple at a time while we get the income going, so that we weren't going in the negative from day one. That's can be kind of dicey, and you'll need some experienced operators to trust when you're going into a project that is negative cash flow from day one. That's what we loved about this property, that it was returning 6% from the day we bought it. And on top of that was a clear path to renovations. I mean, we saw around $200 or more in rental increases for renovations. We put $10,000 a unit in these units, adding washers and dryers, doing a few things that Matt will go into. But we saw a clear path to that value add. And then lastly, an opportunity to improve the tenant base in the community. We saw that while the current tenant base was not ideal, the area supported a better tenant base, supported higher rents, a tenant base that could pay for those higher rents. And that was really important for us. And that's something we look at in all of our projects, is making sure that, can we justify a business plan? Can we justify a $200 rent increase? And so far we absolutely can. And we could when we were buying it.
So I'll touch on a little bit of the project side and the renovations we've done. The unit interiors was essentially a full upgrade cosmetically. New flooring, refinishing countertops, brand new appliances, stainless steel, make it look, and painting the interior, making it look desirable and something that's a welcoming home sight to see. We added washer dryers in each unit, and at the end of the business plan, once all 33 current units have washers and dryers in them, we'll convert that 34th unit that is the current laundry room to another tenant, or to another unit, excuse me. Upgraded the bathrooms, and then from the exterior perspective, one thing we did right out of the gate as soon as we acquired the property is put new signage on. We replaced the roofs on these 3 buildings at this property, increasing the curb appeal. We painted all the doors to the units, changed out the address numbers, changed out the patio lights, making it look much more visually appealing from an exterior perspective. So when you're driving by the property, it's something nice to look at. And so what's changed since day one of acquiring this property to date? We have renovated and leased 10 units, increasing our current average rent from day one at being at $656 to $756. Through these renovations, our occupancy has stayed around 88%, and current distributions annualized to date are at 7.5%. So we were able to beat that metric of going in day one. There was still cash flow, but through renovations and improving rents and operational efficiencies, we've been able to beat that as well. So just from an example standpoint, the forced appreciation breakdown. So we were able to increase rents from day one, and through the rest of the business plan, it'll be on average about $219 per unit that we've increased the rent. Additionally, converting that laundry room to create some more income, that adds $97,000 roughly to just rental income. Now, looking at it from a cap rate perspective, basically what the property is valued at based on the net income, that is adding about $1.4 million in equity just from doing those renovations and operating it efficiently. On the right-hand side, you'll see a breakdown. This isn't the numbers for this property. Just a quick example, if you were to cash flow these percentages through 7 years, that's your cash flow return. And then on the exit, about $150,000. So in all, you're just over $200,000 return of your $100,000 investment, basically doubling your money in that 7-year period. with cash flow throughout the life of the project.
Yeah, and so you can see it takes some time. These deals and these returns take some time to achieve. Now, this is clearly an example, but this is how it works. This it takes some time, and sometimes year one cash flow might not be as juicy as 6%. It might be 2-3%, or you're going through the renovations, and that's okay as long as you're getting that overall return. And as you can see in this particular example, of the 2x, just over 2x that you're getting back. So you're putting in $100,000, you're getting back $200,000. So your capital plus an additional $100,000. The majority of that is happening at the sale, and you're getting cash flow throughout the whole process. So you're getting cash flow. You're able to reduce your tax bill throughout the entire investment, and that is, if not taxed at a very, very low rate, it's tax-free, this income, to be quite honest. So you're seeing these returns live, and we just wanted to give you a visual there of what that looks like for what your capital will do on a year-by-year basis.
Thanks, Aiden.
Sure.
So, so when Matt and Hayden, we decided to put on this webinar, they asked me to kind of speak a little bit about my experience as a limited partner, and Hayden and Matt, they're also limited partners too. So although I am a general partner on that Cherry Street project that we're doing, and along with Matt and Hayden, we are also limited partners too. So we invest our own money in all these deals. And I just kind of wanted to share my experience with you folks and how I got involved with this and why I chose to go this path. So originally, like I mentioned before, I had invested in a lot of single family homes myself, and I knew that wasn't the path that I wanted to go on, and I wanted to invest in multifamily. So, I did a little bit of research and took some education as to how I would break it into that market. And if you went back to the slide that Hayden was showing earlier about all the responsibilities of the general partner in doing that, it's quite a lot. And I started analyzing deals and trying to find multifamily apartments, and it just was so overwhelming, and there was no way that I think I could do this by myself. So, I did a little bit of research and listened to some podcasts and just kind of talked to other people. And I realized that most people that are investing in multifamily are not doing it alone. They're doing it with a team of people. And that's really the key, is the team. So when I say to vet the operator, your sponsor, you really want to find a sponsor that obviously you can trust, that you have comfort with, that makes the investing experience simple and easy to invest. So as I started off as a limited partner, I found those things ought to be true in doing that. So it's very, very simple. Once you decide, the most difficult part is going to just be for you analyzing the project and see if it's a fit for your, a fit for you personally. Once you decide to do and go ahead with it, it's super, super simple. We use a software system called Syndication Pro that literally they manage, not for us, but hundreds of millions of dollars in syndication money. It's super simple. It probably takes maybe anywhere from 10, 15 minutes to at the most 30 minutes to get signed up. Once you're signed up and decide to do it, all you got to do is send the money and you're in, and it's super simple. You get confirmations all along the way, and everything is, all disclosures are very upfront. We want to make sure whatever you're deciding to invest in, you're completely clear as to what you're investing into, and also all the risks that are involved. So there's consistent communication along the way. While when you're in the renovation projects, you'll typically get emails about once every other week, just updating you on the property, photos, videos, keeping you abreast of where where we are with rents and vacancies and filling those vacancies and everything, more information that you'd ever want to get. So you can just read those as your leisure, and just keep abreast of what's going on. We're not, you don't want, when I say we, you don't want any type of investor that just takes your money and just kind of forgets about you. So, and then there's also quarterly reporting. So every quarter you're going to get a detailed, and actually on Syndication Pro, you can log in at any time and get real-time status of your investment. Then there's also ongoing distributions, quarterly distributions, that the cash flow that Hayden was mentioning. And again, this is a long-term strategy. So you can view your investment, through that lens and be able to see your money growing over time.
Yeah, and I wanted to add really quick that in addition to everything that Rory just mentioned, we have lawyers and a legal team that puts together documents, three syndication documents that protect you as the investor, as the passive investor, and protect us. So we can't go out and take your money and run off to Barbados. We have to put it towards the property, and we have a fiduciary duty to perform as well as we possibly can and make sound decisions with your capital. So you are protected as an investor, as a passive investor, and we are protected as an active investor. And all of those documents are uploaded into the portal, and you read through them, sign them before your investment as well.
So part of the background work of general partners or sponsors is finding markets that are suitable for your investment strategy or strategies as you acquire these properties. So we're looking in strong rental markets, as Hayden mentioned. All the demographics and macroeconomics of Kansas City as a whole is something that was attractive to us and fit our investment strategy. So strong rental markets, demographics that fit our criteria of what we're looking for as we go through our business plan. These are like B and C class apartments, not looking for 2026 new builds where everything is beautifully done. Rents are at the top of the market. We're looking to go into a working class neighborhood, a safe neighborhood. Crime is a big factor of that, where we can improve the rents, improve the tenant base and cash flow as we go through the life of the business plan. Clear value add opportunities come from the renovations and being able to increase rents and operational efficiencies through that project. So as long as there's a clear path forward to execute a business plan, and we as the sponsors can underwrite that and are comfortable with our projections, then it's an opportunity worth moving forward on. So as mentioned before, the renovations can take anywhere from 12 months, 2 years to 3 years, depending on the size of the project and what is needed from a renovation standpoint and exterior beautification part, where we can go in and make execute our entire business plan from A to Z in that 5 to 7 year plan.
And with that, not everything is rainbows and daisies. There's risk with every investment. Every time you transfer money, there is risk involved. And some of those risks are execution based with the sponsor, a lot of those risks, and a lot of those risks are out of your control with the market, rising expenses. And so some of I'll mention market changes. Market change can change in an instant, right? You could have a market that has one major employer and that employer could go out of business. That's a major risk. So you got to factor that in: employment, rent growth in specific markets. You got to factor those into your investments. And that's a lot of the vetting work that we do beforehand, but there's still additional risks that come along with that. Rising expenses. Insurance has gone through the roof over the last couple of years, and making it almost impossible to underwrite and figure out what those insurance risks are. But being able to factor those in and add some padding into your underwriting is how you mitigate those risks. So how we mitigate risks as GPs, and how several GPs mitigate their risk is, and you hear it all the time, it's a very overused word in this industry, is conservative underwriting. But what that means is just being able to pad in some additional, built-in reserves, for example, is part of that conservative underwriting. So adding in reserves over and above what you think is necessary for renovations or for any period of time that cash flow might be tight, making sure that you're making these payments, adding in some economic loss, vacancy loss, things like that through your underwriting to make sure that if there is any execution errors or if there are any rising expenses, that you can handle those and absorb those and still get your projected returns. And then also hands-on experience. As mentioned, all three of us own our own portfolio. We have significant experience, and that helps mitigate risk throughout the entire process. And then lastly, we have, who is this a fit for? This is a fit for people who are a long-term mindset. As I mentioned, this is anywhere from a 3 to 10 plus year investment for one specific apartment. And you're not going to get rich quick on these types of deals. And what that really means, and again, you hear that all the time, but what that really means is you're not going to put your money in today and in 2 months, rents are going to go through the roof and you sell for a huge profit. That might happen. That might be a unicorn. We don't know, but that's not what this investment strategy is for. Also, if you're looking for a little bit of passive income, if you're looking for something that you can put your money in and your money goes to work so that while you're working your job, you increase your income and add a vacation fund, add, more income to your household. It's also for busy professionals, as we mentioned earlier, people who have a W-2, who have their own businesses, who don't have the time to do everything we've talked about. And you put your money with sponsors and trust these sponsors to grow your money. And then it's not really ideal for people who are looking for that quick transaction, for people who are looking for liquidity. This is not a liquid event. You're not able to put your money in and say, oops, actually let's pull out when something goes bad. And if you do, it's going to take some time to get that money back. It's not going to be overnight. You can't click a button like you do on with stocks. And then lastly, desire for control. As an LP, if you want control, you're not going to have it in these investments. The GP controls the investment. While you control a major part of or a majority of the equity, the GPs control the day-to-day operation. So if you're looking for that control, more of an active investment is probably going to fit your needs. So we wanted to add that in there as well. And lastly, how do you get started? Contact us, connect with us. You can email us at any one of these emails. Connect with our Instagram. We'll also be putting this on our YouTube channel, which is Doer You're a Commie Group. YouTube channel. So we're putting this all on here. Join our investor list so you get first-hand access to all the deals that we provide, all of the opportunities that we provide. And so that's kind of how you get started. Reach out to us, and we're happy to connect with you. Like Rory mentioned earlier, we're a smaller company that prides ourselves on our communication and our direct communication with our investors. So. And now we will open up to a Q&A. We saw some questions coming in throughout the webinar, so I wanted to go over a couple of them. We have a couple of minutes, just about 4 or 5 minutes, so we'll go over them all, kind of fire these off. When do investors start getting paid distributions?
So quarterly, this can vary on deal to deal, but quarterly distributions, those come out on a calendar basis, so end of Q1, Q2, Q3, and after Q4. And it's roughly, depends on the operator, but about 3 weeks after the quarter ends, you'll see the distribution hit your bank account direct.
Yeah, and that can happen within that first quarter. That can happen within the first 6 to 9 months of your investment. It really just depends on the strategy, and that is communicated beforehand. It's communicated when your first distribution is going to be given to you. Now, next question is, can investors go and see the property throughout the investment?
Rory, I'll let you take this one
Oh, absolutely.
about Cherry Street.
Yeah, absolutely. I actually went there several times, so you're welcome to go, and I'd ask you to communicate with us, but it's definitely, you actually own part of the property. So we're not, please don't go knock on anyone's door and ask to go inside their unit if it's tenant occupied. But if we do have any vacancies, we're welcome to try to schedule a time to go and take a look at it, but we're completely transparent.
Yeah, that's perfect. Yeah, I would agree. And there's 2 more questions that came in, and the first one is, how much money do you need to invest in one of these deals?
This one always trips everyone up. They think you need hundreds of thousands or millions of dollars to get started. Again, this is always deal dependent, but you could need as low as $25,000 to invest into a syndication. And like Rory was saying, you have access to these deals that are going to have 10 units all the way up to 250 units. So you have access to larger deals, and really you only need 25,000 to get started.
Yeah, 25 to 50,000. And when we start marketing deals, we will have the minimum amount for that specific deal in the marketing materials, so you'll know. But yeah, 25 to 50 is pretty common for these smaller deals. Sometimes it can be $100,000 or more. It just depends on the how it's set up. And the last question that came in is, if I were to want my money back, if I were to invest in a deal and an investment or something were to happen throughout that time frame, emergency, and I need that money back, how or can I get my money back, and how can I?
Yes, you can. It's not necessarily a liquid asset, like Hayden was saying. There's no button to press to say, "Oop, need my money back." You can have you can have a conversation with the general partners, explain the situation and what you're looking to do or the reason you need your money back. And we as operators would do our best to try and help that situation. But the way it would have to work is basically you're buying shares of this property. And so you would need to sell your share to another potential investor or limited partner, or there's the option to have the general partners essentially buy your equity or shares of the deal, and that's how you'd be able to get your money back. So yes, there is an option to do it, but it doesn't happen overnight.
Yeah, and it's communicated up front. All these questions are great questions. These are communicated up front when we're marketing the deal, and also in these legal documents that we mentioned, the legal documents of how to get your money back, how it works, when distributions will be given. All of these questions will be answered in the legal documents and in the marketing materials. And like Matt said, we can work something out. It might not be day one that you ask for it. It might take some time, but you can absolutely be bought out of your investment. But
I had one.
Anyway,
I had one
yeah.
question that came in on a text. It said, do I actually own a piece of that property, or am I just investing with you guys to buy the property?
Go ahead, Matt.
Yeah, you own a piece of that property. The equity share is where your portion of that ownership comes from. So general partners own, we'll say 25%, like we used in the example. The limited partners or the investors own 75% of that. So if it's $1 million raise and you invest 100,000, you own 10% of the LP equity in that deal. So yes, you do own a piece of that land. Now, again, mentioning the debt portion of this, you are not responsible or held liable for the debt on the property or the mortgage on the property. That is solely based on, or solely falls on the shoulders of the general partners.
Yeah. And that goes back to why we love real estate and why we love multifamily specifically, is that you're buying a piece of property, you're buying a tangible asset, and that asset is worth something to somebody. And, worst comes to worst, you're able to get your money back or a portion of your money back on a majority of these deals. Now, we don't guarantee that, and hopefully the market, if the market goes south, it's going south for everybody. So it's not necessarily ideal, but that is certain things that are out of control. But it's a tangible asset that somebody ideally, and for the the history of time, people have wanted, and it's valuable. So that's why we like it. Yes, you do get a portion of it, and that's why we are big fans of real estate in general. But anything else? Any other questions? I think that was it that came in.
Yeah.
Awesome. Well, again, we appreciate you jumping on, and we will be doing this every quarter. And if you have any other questions or you want to get involved, please feel free to reach out to us. We're happy to connect.
Thank you.
Thank you.
Aloha.